Hi guys, welcome back. Joe here from 9 to 5ers, and we're going to be talking about types of real estate investing, and today we're going to be focusing on passive income. We've already done a video on active income, so make sure you check that one out. But we're going to focus on the other end of the spectrum here, which is passive income. The overview we're going to be talking about today is going to be the passive part of income. Like I said before, we're going to talk about, we're going to explain it, we're going to do the pros, the cons of it, and what should you do? Let's ask some probing questions to see if we can't figure out what you need to do or where you need to move forward here, and how you can take action right now if you decide to move forward with it. So, quick disclosure here, guys. This is for informational purposes only. Obviously, we're not a lawyer. We're not lawyers or public accountants or financial advisors. This is just for educational purposes only, to help you ask better, more informed questions to maybe kind of figure out where you should go next, like type of thing. So, without further ado, let's just move on here to the next thing. So, active income obviously is the flipping and wholesaling part of the business. The other end of the spectrum, we're going to be doing buy and hold, which would be type landlording, property management type stuff, or notes. And notes are basically when whoever holds a note is the bank. A lot of people don't know about this, but you can actually be the person that owns the mortgage or the promissory note on a, actually it's both, on a property. So let's do a hypothetical here. I go out, I find an amazing deal, and I'm like, man, I love this deal. This deal is a killer. It is, I've done my due diligence, but I just don't have the money. And right now the banks aren't lending. So I would go and find a private lender that has the cash. They would purchase the property for me after they do the due diligence on it, but they don't want to like own the property and manage it and deal with all that stuff. I'm the one that wants to do all that type of stuff. So I would make a payment to them based off of the promissory note and the mortgage, and they would sit back, collect their check, and I would be the one that runs the business, the day-to-day. The tenant would pay me, and everybody would be happy. That's basically what a note is. The note is a person that owns the debt on the property. They've clouded the title, so to speak, where there's a lien on the title because they are the ones that have the debt, the mortgage on. I don't own the property outright. And then there's the hybrid method, which we'll talk about in a future video, which is a mix of topics 1 and 2 there. A description of buy and hold. Well, a buy and hold is a property type. It's going to be a single family home or a small multifamily home, or it's going to be an apartment, which I personally consider to be 5 units or more. Once the insurance agents or the local laws start to classify the property as commercial, that's when I just decide that it's a commercial property. It could be, in some areas it's 4 units, some areas 5 units, whatever it is, it doesn't matter. But a duplex is still considered in most areas a residential focused home. Apartments are commercial type and they're classed a little bit differently. And a small multifamily is that middle area that is not a single family home, but it's got multiple units, but it's still considered a residential type of area. And then there's commercial businesses, which would be like if I owned a car dealership, or if I owned a strip mall, if I owned a building, a big box, and you could put something in it and make a business out of it, basically. And there's also storage, self-storage that you can do there too. You rent to the residents or the business. If someone's going to live there, then they pay a monthly mortgage. If business is going to pay a monthly mortgage, or if it's a storage facility, then they're going to still pay a monthly rent on it, but it's going to be, they're going to pay they're not going to live there, but their couch is going to live there. Rent pays expenses. So that's the next step of it. Unfortunately, we have to pay for repairs that need to get done on the property, insurance to insure the property, taxes that we have to pay on the property. And then if we have a debt, like if we owe money on the property to a private lender or a bank, then we have to pay a mortgage on that. But the mortgage always comes in. I always put that last because the first 3 things there, you always have to pay kind of no matter what, if you're smart. Lease and local laws will dictate whose responsibility of what everybody's responsibility is. So the lessor or the lessee. Now, this, you have to follow the local laws. That's kind of like your guideline of what you can do. But I'll give you a couple examples here to kind of to realize that it's not just cut and dry. So let's say we're doing a commercial building and the roof starts to leak. Well, if it's commercial, there is some local laws will say, hey, that's on the tenant. Like in that, and you can put that on the tenant's responsibility, and they got to pay for it to get patched and whatever. But if it's like a residential thing, well, the person that's living there, they're just renting the place, and if the roof starts to leak, that's on the landlord or the person that owns the property has to get that fixed. Another example might be, let's say that in one of my properties, I furnish the appliances, the washer, the stove, and the refrigerator. I furnish all of that, and with that comes a higher rent that they're paying. Well, that tenant is paying for those conveniences to be there, and obviously in good working order. So if they break, then it's on me to fix it. Let's say that I have another property and it doesn't have a stove, it doesn't have a fridge, and they just have the hookups there for the washer and dryer. Okay, that's fine too. They're probably going to pay less in rent because they have less amenities. And if the stove breaks or the refrigerator breaks, that's on the tenant to pay for it to get that fixed or replaced or whatever. So, follow the local laws. That's important. Have a good attorney look at that for you, what you can do, and they can draw up a lease for you. Make sure you find an attorney that is competent, and they understand real estate investing. That's very important. You can be a one-man band or a one-woman band, or you can be 100% hands-off on this business. You can go the two full ends of the spectrum. You could be the person that shows the property, unclogs the toilets, fixes the roof, redoes the foundation, cuts the grass. You can do all the things, or you can hire that out to everybody else. And there's pros and cons to both sides of that. Make sure you're planning for vacancies, and make sure that you are putting back a little bit of money every month for larger repairs. So a hot water tank, an HVAC unit, and air conditioning and a roof are not going to break, every 3 or 4 months. They're going to break long periods of time, but they're also not cheap to fix either. It's not like fixing a handle on the sink. It's going to be expensive to fix those things. It's going to be thousands of dollars for at least the roof and the HVAC unit. So put some money back so that you are ready for those big expenses. And then the way that I look at this, I've been doing this for about 10 years now. Tenant plus location plus management equals either a profit or a loss. So if you have a great tenant and it's in a good location and you are managing that place correctly, you're going to make a profit more than likely. Now, you could do all those things and then have to replace a roof and a hot water tank and an HVAC unit in the same year, and you're going to lose money. That's a bad year. But, that's, like I said, that year is only going to happen once every, 30 years, so to speak, depending on how long a roof lasts in your area. But if you have a great tenant, great location, and you have a great management system in place, whether you're running it or not, you're going to make money. That's the 3 big things you got to focus on there. And if you can crush all 3 of those, it's hard to lose money. It's not impossible, but it's hard. Buy and hold pros. So the pros of it's a great way to build wealth. Your house is generally going to appreciate if you have it in a decent neighborhood. In my state, houses generally go up by 1% every single year. Yes, there's ups and downs in the market. Like, it could go way up, for 5 years, and then it could take a dive and go down. But over the long run, in my area, houses go up by 1% a year, which isn't a lot of money, but that's nice to count on. Rental income. It's generally what you're going to, it's going to be great if you have it leveraged. You're going to make a little bit of money, but it's going to be awesome if you don't have it leveraged, because then you don't have any debt service on the property. And it's a tax shelter too. If you're a high income earner, if you're a doctor, an attorney, or a CEO of a company, you make 6 or 7 figures, buying rental properties is a great way to shelter your taxes. And as you pay that property off, then you owe less on you owe nothing on it, and it's appreciated, and the rent paid it off for you. That's a great way to build wealth. It can be very hands-off and turnkey. So if you are a person that's just like, there's a lot of people out there that are just like, I don't want to own rental properties because I don't want to fix toilets. Well, I know landlords that don't fix toilets. And guess what? I'm one of them. I've never fixed a toilet in my entire life. I don't know how to fix toilets. I call up my general contractor. I send him out there. He meets with the tenants. He fixes the toilet. He sends me a bill. I put a check in the mail, or I send him the money, whatever, and it's done. So it's up to you. Are you hands-on? Are you hands-off? There's pros and cons to each side of it. And like I said, it can be very turnkey. There's a bit of a learning curve to it compared to, say, the stock market, but you get paid for that learning curve for sure. And you can use equity to buy other assets. So let's say you have 4 houses that are paid off, and they're each worth $200,000. So that means you got $800,000 in equity in houses. Now, more than likely, you can't pull out all of that money, but you could go to a bank and go, hey, listen, I got 4 properties here. They're all paid off. They're all worth $200,000, or they're all worth $200,000 each. How about I pull out 50% out of all of them? More than likely, a bank would take a commercial line of credit or a home equity line of credit at 50%. And, depending on what their current terms are, and you could go out and you could buy more properties cash, and you did it with your own money, and the bank was just kind of the intermediary that just kind of facilitated the process to do it. You can build wealth faster if you leverage assets that are already paid off. Multiple exit strategies. With a single family home, there's tons of exit strategies with it. You can keep it forever. You can give it to your grandkids. You can sell it to the tenant. You can sell it to another landlord. You can sell it retail to someone down the road. There's tons of exit strategies for them, and there's also exit strategies for other types of rental businesses too. I just picked the single family home because it has the easiest and the most, basically. And you can pay higher than a flipper can. A flipper has to fit their offer inside of that goalpost. They cannot pay more than this, or it's just not worth their time to make money. With a buy and hold type of business, you can pay almost anything for the property if you can cash flow every single month, every single year, minus the ups and downs of fixing roofs and whatnot. So you can outbid a lot of other people that are flippers, or they only have blinders on their head. They can only do one thing. The cons of buy and hold. Well, you guessed it. Tenants can be a nightmare. They can destroy your property. They can fight you in court. They can, it can be a nightmare. But I would say 95% of those nightmare situations can be eliminated through just having a good system in place and not letting them get in your place in the first place. A bad apple might get through there now and again, and there's actually ways to get around the bad apple. You can say, hey, listen, you're not paying. How about I just give you cash for keys? You move out, and I'll help you move, type of thing. Because a lot of times tenants, they can go bad, but it's not really that they went bad through maybe no fault of their own. A tenant can't pay you rent if they lost their job and they can't get another job. But if you paid them a couple $100 to move and they left the place great, then that's making the best of a bad situation. There are tenants that are like professional, quote unquote, tenants that are going to go in there and be nightmares. Like that type of person does exist. But and they might slip through the cracks every once in a while. But the thing of it is that for every story you hear about a nightmare tenant, there's 100 stories that are, I went to the post office and collected my check and cashed it from the tenant, and the tenant never called me, and it was a great situation all the way through. And they stayed there for years, and they never were a pain in the neck. Those stories just don't make the paper because they're boring. They don't get passed around because they're boring. The nightmare tenant stories get passed around because they're crazy and they're exciting / scary, whatever you want to call it. So, but they can be a nightmare. But I also say that you can also mitigate that down to next to nothing, but not nothing. Locations can go bad. So you could be in an area where it's not the best neighborhood, but it's also not a terrible neighborhood, and the neighborhood can go south. There is that issue. You could have a losing year, like I said before. If you're replacing a hot water tank, if you're replacing a roof, and you're replacing an HVAC unit, and you have to put new flooring in a property in 1 year, you're not going to make any money, especially if it's a single family home. You're just not going to make money that year. That's going to be a pain in the neck. But also I also say, well, you're not going to replace a roof, an HVAC unit, and a hot water tank every single year. And flooring should last more than a year. So maybe you have one bad year, and then you have a lot of good years in between those bad years, quote unquote. And the stock market, it has bad years too. So it is what it is. You don't make a lot of money if it's heavily leveraged. And generally that's kind of the buyer's problem that does that. Don't chase a bad deal. If it's not a good deal, then don't go after it. And, don't sign on for a deal that is not going to cash flow you enough money. If a hot water tank it breaks, and that's going to wipe out your entire year, and that's the only thing that went wrong, then that wasn't a good deal in the first place. So make sure your properties are not heavily leveraged. Make sure you're cash flowing a decent amount to where you can pay for a hot water tank, you can fix the sink, you can replace a toilet, and still make money that year. That's important. And it can be a job if not properly set up. Like I said before, if you're trimming trees, cutting grass, changing toilets, painting the side of the house, putting in new carpet, man, you better make sure you're getting paid for all this stuff, because that's a freaking full-time job. That goes back to, if you have a decent amount of cash flow, you can choose whether or not you want to do it yourself. You can do it for free and your cash flow grows, or you can pay somebody else and your cash flow shrinks. It's up to you. But if you have proper cash flow coming in and out of that property, month after month, year after year, you can kind of mitigate that loss. But you can also just decide to do everything, and it turns into a job. But that's an elected job. So how do you evaluate a property? Like, how do you evaluate a property if it's a good rental property or not at a very high level? And we're just going to walk through this at like I said, a very, very high level. So take the projected rent. And the projected rent is, if you're just like, well, how do I know what the projected rent is? Well, look in the advertisement section and look and see if you were like a potential renter. So what are the comparable properties in that area renting for? Is it the same school district? Is it the same amenities, the same beds, same baths? Do they offer pets? Do they not offer pets? Do they have a garage? Is it an apartment? Is it a single family house? Is it a duplex? Try to find a comparable and see what other landlords are asking for. And also look at what type of manager are you going to be? Are you going to be one of those ones that never fixes anything and it's just going to be a bum? Well, you're not going to keep a tenant for very long, or a resident for very long. But if you're going to be on your game and fixing stuff quickly and making sure that everybody's happy, you can ask for a higher rent. Absolutely. So find out what the average is. And, if you're brand new to the market, then it's going to be a little bit of an educated guess. But if you have 10, 15, 20 properties in the area, you're not going to need to look at anybody else's property. You're going to pretty much know quickly whether, what the projected rent is going to be based off of past experiences. So projected rent. Now take out the monthly taxes, whatever those would be. Take out the monthly insurance. Take out the monthly repairs. Now, if you're brand new to this, you're not going to know what the monthly repair average is going to be. So you're going to have to kind of guess for the first year. And you're going to also need to, then you'll kind of make a more educated guess once the years go by. I would, me personally, monthly repairs. Now, obviously, you're going to have months where you don't repair anything. And there's going to be other months where you can repair like 3 or 4 things. So just kind of take an average of what that would be. 50, 100, 150, 200 bucks for repairs. It's going to depend on the situation, what things cost in your area, and what type of property do you have? Is it an Airbnb where it turns over a lot? Or is it a single family home where the tenant has to supply everything? Like the refrigerator, the stove, all that type of stuff. That's less thing you have to worry about. And then reserves. Reserves are separate from repairs. So a repair is something that you would probably have to fix every 1 to maybe 2 years type of thing. So maybe a screen, you need to rescreen a window, maybe replace one window. That's not replace all the windows in the house, but a reserve would be a bigger appliance that's definitely above $500 that is not going to need to be replaced on a regular basis. So we're talking like an AC unit, we're talking about an HVAC unit, we're talking about a roof, we're talking about a hot water tank. Maybe if you supply appliances, a stove or a fridge, none of that stuff breaks every single year. Maybe you need to remove a tree, maybe 5-10 years from now. Okay, we'll put back 50, 100, $200, whatever makes the most sense for your area. I'm just kind of spitballing numbers here, but you'll figure out what that number is. The main point is put back money before you buy the property. Like mentally put that money back so you get the right number down there. Vacancy rates. The property will be vacant at some point. The lowest I've ever seen in my area, and I'm talking the lowest, is like 2%. The highest I've ever heard of is maybe 12, 15%. Depends on your market. If you live in a market where it's just huge swings, like up and down in rent, in vacancies, like it's just huge cycles, then you get to go for a higher number there, because it could go from 0 to 25, 30%. I've never seen it that high, but a vacancy rate also depends on the type of property that you have. A single family home is going to have a lower vacancy rate than an apartment or a multifamily apartment, like a huge apartment complex, just because people want to live in a house versus an apartment. That, if they had to pick between the two, they're both costing the same amount of money. A vacancy rate is going to be represented as a percentage, and it's going to be based off of how many months per year is it going to be vacant. Is it 1 month? Is it 10 days? Is it 2 months? You'll kind of have to figure that out on your own, but make sure you put that back in there. You're going to get then what's called a net operating income. Now, all of these things in here that I've talked about, taxes, insurance, repairs, reserve, vacancy rate, those are all expenses that you'll have to pay no matter what. Debt service is going to be the next thing you're going to be focusing on. That's going to come after your NOI, your net operating income. Debt service is, in layman's terms, a mortgage, your debt on the property. You get to pay the Chase Bank or whoever it is, your mortgage. Then that comes after the NOI, because that is either going to be there or it's not going to be there. You can pay out the property. And then after you pay off that, then you got your cash flow, which should be positive. And that cash flow needs to be positive enough to where it makes sense to buy the property. If it's $50, you should not be buying this property. If you're, after all this stuff, you're only cash flowing like $50, no, don't buy the property. On market deals, how to find deals. Well, on market is going to be your MLS, the multiple listing services, your realtor.com, your Zillows, whatever it is. Off market is the same way that you find wholesale deals. So that's bandit signs, that's Facebook ads, that's Facebook Marketplace, that is business cards, that's talking to, finding a vacants list, a house that are vacant from your local city, maybe finding a list that has from code enforcement, the people that have code violations in them, that you can do direct mail to those people, out-of-state owners, putting up a sign, we buy houses, those types. Also add in RIAs. If there's always a landlord there that's looking to sell something, there's always a landlord looking to buy something, be one of those people. How to start? Well, find an investor-focused realtor, licensed realtor, and tell them, hey, I'm an investor. Do you work with investors? Do you own properties? They might say yes to the first one just to get somebody in there, but just say, hey, listen, do you buy properties too? If they say no, I would move on. And then also, where is your target area? Is it wherever there's deals, or is it within 25 minutes of your house? What are your school districts? Do you care? Do you only want to invest in the good school districts, or do you want to invest only where deals show up? That might be two different areas. It might be the same area, but it might be two different areas. And then, of course, your local RIA, like I said before, Start there, talk to people. Hey, I'm looking to buy XYZ in this area. If you've got a property that you're looking to sell, let me know. Be open to saying yes to different deals. That will get you deals faster. If you have a laundry list of criteria that person has to meet before they can sell you a property, the less chance someone's going to come to you with a deal. The more open you are, like, hey, I'll buy anything. I'll buy anything anywhere as long as it makes sense. Then more people are going to come to you. But obviously, only buy properties that are going to cash flow, make sense, fit your portfolio objective. It fits in your vision. That's what you want to do. But a local REIT is a good place to start. Now, moving on to notes. Description. Guess what? You are the bank. Most work is done prior to the execution of the sale. This is your due diligence. You really don't have a lot of work to do after the sale of the property is completed. You basically have to sit back and collect your payments and follow up with them. Maybe drive by the property if you want to, follow up. Are they taking care of it? Is it turning into a disaster? Are they doing what they're supposed to be doing with this property? But the most 95% of your due diligence is going to be done prior to the sale. We'll get into that a little bit later on here. So due diligence is 100% based on your criteria. So what I mean by that is what you decide is a good deal and what is not a good deal is based off of what you think, not what anybody else thinks. If someone brings something else that is outside of that criteria, it's a no. Stick to your guns. If you stick to your guns, every private lender that I've ever talked to, every single bad deal that they've ever had to do went bad because they went outside of their criteria. So I'll give you an example of your criteria, a criteria list that someone could use. So let's say you're only one that lends 65% on the after repair value. The buyer needs to bring the money to the table if there's anything that needs to be fixed, and they need to show that as proof of funds. Like, hey, this is my bank account. I got $20,000 here. I'm expecting to spend 15 of it, but I got 5 more just in case something goes wrong. And you're like, okay, that makes sense. Great, got it. Scope of work must be walked off prior to the close. So let's do an example here. They're just like, hey, I think it's going to cost $15,000 to repair this house. And you walk in and you're like, okay, carpet, paint, appliances. Okay, makes sense. You got to fix part of the roof, not all of it. You got to put a new HVAC in, but that's basically it. Okay, $15,000 is pretty close. If you walk into a house and they're like, okay, we're going to gut everything and we're going to rewire the entire thing. We're going to fix the foundation. We're going to re-roof it. We're going to put brand new appliances in here. You're like, whoa. This isn't even close to $15,000. Like $15,000 is like the first 2 weeks of work. And we got, 2 months worth of work here. Not even close. So the scope of work has to match the amount of money that they're saying it's going to cost. Now, whether you bring that money to the table or they bring that money to the table, that is up to you guys, up to the people. But it has to match, has to make sense. The exit strategy has to be mapped out. I like to say, like, hey, listen, I'm going to do this. This is what, if I was going to go to one of my private lenders, I would say, listen, this is what my exit strategy is. It's going to be a buy and hold. I'm going to put this amount of money into it. This is what I think it's going to cost. I'm going to bring that money to the table. This is what the local rents are in the area. I think I can get $1,000 out of this property. I think I can get that based off of all these comps. But if I can only get $850, I'll still cash flow this amount of money and I'll be able to pay you guys. So I can fit in this range. That is me telling them my exit strategy and also my plan B. If I could go down to $850, which is what the apartments are going for right now in this area, the apartments are going for $850 and it's a 2-bed, 1-bath, and it's an apartment. Okay, I got a 3-bed, 1-bath, and it's a house. So worst case scenario, I have to match an apartment that has less than what I'm offering. That's the worst case scenario, and I can still cash flow every single month. That's what note holders want to see. Terms of the loan, how much are you borrowing? What's the interest rate? Is there a payment penalty? Is there a balloon payment? How long is the loan for? Do they have to hold insurance and keep the note buyer as the interested party or clause under the insurance type of thing, like you would do for a bank? Lots of stuff on there. The terms of the loan can get detailed, but that's also in there. Like, what are your terms? What are your absolute have to have terms? If then scenarios. So an if then scenario would be if they get 60 days behind, then they have to quit claim the property to you and just walk away from it. They're avoiding a full foreclosure type of thing. Now, that kind of stuff you have to kind of obviously have to talk to an attorney and kind of map out what you can do legally, what you can't do. But you need to have if then scenarios in place, and not only do you have to have them in writing and signed, but you also need to talk about them up front. Just go, hey man, if you blow this up, like, what are we going to do? Like, and they'll say, hey, listen, if I blow this up, this is what I'll do. You need to have the verbal agreement needs to be the icing on the cake, not the whole cake. It needs to be in writing. Notes, the pros, very, very passive. That doesn't get much more passive than notes, because you're basically just sitting at home watching a direct deposit come to your account once a month. You need a phone, an internet connection, a place to wire the money, and cash. That's basically it. You could be in another country and do this if you wanted to. Your criteria is king. That's your filter. If you have strong enough criteria, yes, you won't get all the deals that are out there, but you also get the deals that you want to get that fit your criteria. You should be getting better than market returns. The stock market, let's just say that the average return is 7% over the lifetime of the market. Then you should be able to beat that. Diversify your portfolio. You know, if you have 100% of your investments in the stock market and the stock market takes a dive, then 100% of your portfolio just took a dive. But if you have money in different things, it helps diversify it, which is great. Real estate is generally more stable than the stock market. That's kind of my personal opinion. But the stock market, it goes up and down 1 million times a day. It seems like the price of a house doesn't sell that often. It trends up or it trends down in a more predictable fashion than the stock market does. So it's a little bit more stable than the stock market is. Cons of notes, your hands off means that everybody else needs to be competent. You know, you have to follow up with people. You have to make sure things are getting done. Are the payments getting made? If they're not, you know, are they paying a late fee? What's going on? Are they doing what they're supposed to be doing on the property? You have to have cash. I mean, that's basically it. You're a note buyer. You have to have cash. You have to have access to cash some way or another. And there is a possibility of foreclosure. If things just go completely south, any investment can go completely south, no matter what. I mean, it is what it is. Stocks, bonds, real estate, investing in gold, whatever. It can all go south. It's a risk no matter what. And notes have that too. So guys, what do you think about this? Do you have any questions about this? You guys would like to see future videos that go deeper into passive income? Do you want to learn more about notes? Do you want to learn more about buy and holds? What's your questions? What types of investment challenges have you had in the past? Click like, comment, subscribe. Check us out on Facebook, 9 to 5ers. We really appreciate it, guys. Thank you so much. Have a good day.